Hello. In this video, we'll be going through our third part of correction of an error and going through self-correcting and non-self-correcting errors. There are many ways accounting changes can occur and for many reasons. And one of those reasons is a correction of error. An error is caused by a transaction being recorded incorrectly or not at all. Errors can be a mathematical mistake that gets recorded, inaccurate physical count of the ending inventory, a change from the cash basis to the accrual basis of accounting, not recording an entry, recording an entry incorrectly, such as recording an asset as an expense or vice versa, or it could just be fraud or gross negligence. For whatever the reason, when a correction of error occurs, we need to know how to account for it and disclose it properly in the financial statements. We're going to go through an example and see how this works out. In early 20X3, Overseas Wholesale Supply discovered that $10,000 of inventory had been inadvertently excluded from its 2000X1 ending in inventory count. So this is an analysis of what happens when you have an ending inventory that is understated. So U is understated and O is overstated. And it takes you through the year one and year two, what happens and how in this situation it is self-correcting. So you can look at this, but first I'm going to go through a numerical example to outline this because I think it's just a little easier to comprehend, and then we'll come back to this slide. Okay, so we have this company in year one where this is what should have been recorded. Our beginning inventory was 75, purchases is 125,000, our cost of goods sales 200, that's a subtotal 200,000. Our ending inventories should have been recorded 50,000, which results in cost of goods sold as of 150,000, right? Because our cost of goods sold available for sale less ending inventory equals cost of goods sold. Well, this is what actually did happen. We understated our ending inventory by $10,000. So we still have beginning inventory 75, purchases 125, cost of goods available for sales 200, but now our ending inventory is 40,000 and our cost of goods sold is now $160,000. So if in year one, it means our ending inventory is being recorded at 40,000, so it is $10,000 understated, and the cost of goods sold is 160,000 rather than 150,000. So our cost of goods sold is overstated. So now we're going to go into year two, right? Because we recorded this $40,000 of our ending inventory. So that's going to go right in here into our following year, our 20X2 beginning inventory number. If we had purchases again of 125,000, now our cost of goods sold available for sale is 165,000. We do a physical count of our ending inventory at the end of year two and get 50,000. And now that means our cost of goods sold recorded in year two is 115,000. Had we done it properly the entire time, then we would have just looked at column D, which is our correct balance. Then the ending inventory of 50,000 would have just come into the correct beginning inventory for the following year. And assuming all the same facts, our cost of goods sold would have been 125,000. So what happens in year two is now our ending inventory is 50,000, which is where it should be. And our cost of goods sold now is understated by $10,000, right? It should be 125,000. What gets recorded is 115. So let's see what happens in total. In total, at the end of year two, ending inventory is the correct balance. And then this is if we don't record any correcting entries in year two. If we discover this happened in year three, then our cost of goods sold between the 2 years, if we did it correctly, we would have had 150,000 year one plus 125,000 year two. You can see down here, that would have given us $275,000 of cost of goods sold had we done everything correctly. But instead, we recorded 160,000 year one and 115,000 year two. also gives us a total of $275,000 in total over the 2 years for cost of goods sold. If we discover this error in year 3, this is a self-correcting error, which means, yes, we recorded things incorrectly in year 1, and we recorded some things incorrectly in year 2, but then by year 3, everything is correct. Our inventory balance is going to be correct, and the total cost of goods sold that we were supposed to take cumulatively over the last 2 years is also correct. In that situation, if we discover this error after the errors have self-corrected, then all we do from a financial statement perspective is we have to disclose that as a prior period adjustment, and we'll go through that. There's no journal entry that is required to be recorded, because what would you record in year 3? You have nothing to record to retained earnings, because your cost of goods sold is correct cumulatively, which means your retained earnings is correct, and your ending inventory is also correct because it was recorded at $50,000. So coming back to this slide, right, where you see kind of everything that follows from 20x1 to 20x2, it just shows you everything that was understated or overstated and how it kind of all flows through. But at the end of the day, at the end of 20x2, it is all self-correcting, including the retained earnings amount is self-correcting. So what if we discover this error before the closing the year 2? Well, in that situation, let's see what happens. Whenever you discover an error after the year that it occurred, and if you need to record an entry to correct it, in this situation, if in year 2 we've discovered this error happened in year 1 and we have not yet closed year 2, we must record an entry to fix year 1. So what we would do is we would look at year 1 and look at what happened and decide what entries are required depending on the error. Well, if I'm in year 2 and I'm looking at year 1, I see that my inventory is 40 and it should be 50. So I'm going to debit inventory for $10,000, right? I'm going to increase it by $10,000. And where's my credit? Well, my cost of goods sold is $160,000, right? That's what I recorded in year 1. It should have only been $150,000. So I need to reduce my cost of goods sold by $10,000, but I can't, because you can't, because the income statement from the prior year is now closed, but that net income would have flowed into retained earnings. So my credit is going to go into retained earnings from the prior year for $10,000 by $10,000, right? We have 160 and it should have been 150. So my second step, if I discovered the error in year 2, after I record that journal entry to fix my accounts, my GL, I also, when I post my, when I issue my financial statements, my year 1 financial statements are going to be retrospectively restated. It's going to have the correct inventory amount, the correct cost of goods sold amount, and we're going to have our beginning retained earnings from going into 20x2. We'll have a prior period adjustment to account for that $10,000 for the cost of goods sold from the prior year. However, if that error had been discovered in year 3 or later, then we already know that's a self-correcting entry, and know, right, because the retained earnings is correct, my ending inventory is correct. There's nothing to record on my books that need to be corrected, but my presentation, my financial statements does need to be adjusted. And in that situation, if it's discovered in year 3, then both my year 1 and my year 2 financial statements have to be retrospectively restated to reflect the proper inventory, cost of goods sold, and retained earnings. So here's what would happen in the financial statements. Whether we discovered it in year 2 or year 3, our 20x2 beginning retained earnings balance we'll have a prior period adjustment for that $10,000, that it would have an increase to retained earnings because our entry would have been debit inventory, credit retained earnings. And that would either go on the statement of retained earnings if they had one, or the statement of shareholders' equity for that corporation's, within that corporation's financial statements. If you're not familiar with the prior period adjustment, please see the prior video, because there's a whole entire video devoted just to how to properly record the prior period adjustment, and with various scenarios as to when, depending on when the error is discovered, how the prior period adjustment should be reflected within the financial statements. And then, as is the case with any type of change in accounting, whether it's an error or estimate or a change in accounting principle or reporting entity, there's always a disclosure note that's required in the annual report. In this situation, we have to disclose the nature of the error, the impact of its correction on each year's net income. So if this was the 20X3 financial statements, we would have to say that net income was understated by $10,000 in year one and overstated by $10,000 in year two. And the same thing happened, the income from continuing operations, and how that would affect earnings per share. Also, keep in mind, these errors are only disclosed and recorded if they're very material, and that'll be decided by the corporation and its auditors. Okay, let's take a different kind of error, and this one is when we fail to record sales revenue in the proper period. In 2027, General Paper Company discovered that $3,000 of sales the last week of 2026 were not recorded until the first week of 2027. The merchandise sold was appropriately excluded from the 2026 ending inventory. So this last sentence, it's just telling you when it recorded the sale, it might have recorded the sale in the wrong period, right? Because they recorded the sale in 2027 when it should have been recorded in 2026. But this last sentence just says, whenever we have a sale, we have to record the sale, but then we also have to remove the inventory from our books. We would debit cost of goods sold and credit inventory. So this is just saying that the inventory was actually removed from the books in 2026. So we don't have to worry about that piece of the journal entry in this example. So here's what should have happened versus what did happen. Okay, what should have happened is in 2026, they should have debited accounts receivable for 3 and credited sales revenue for 3. And in 2027, they should have not had any entry related to this transaction. What happened instead is that in 2026, they didn't record it. Instead, they recorded the accounts receivable and sales revenue at the end in 2027. Okay. Now, let's see, this happened they discovered it in 2027. Let's just say, before we get into this example, they discovered this in 2028, that this actually occurred in 2028, then it would be considered self-correcting, because your accounts receivable, well, probably by 2028, hopefully that accounts receivable is gone because it's already been paid off by the customer. But even if it wasn't, at 2028, you still have accounts receivable on your books for $3,000, and your sales revenue would also be on your books for $3,000, and therefore included in your 2028 beginning retained earnings. So if this happened in 2028, then that means it would be self-correcting, and we have no journal entry. Now, just because you don't have a journal entry does not mean you don't have to restate your financial statements for the prior years to reflect the proper accounts, that the accounts receivable should have been $3,000 higher in 2026 and $3,000 lower in 2027, and same thing for revenue. But no entry would be recorded if this error had been discovered the following year. Now, but let's just say it was actually discovered in 2027 before the 2027 books were closed. So first thing we would have to do is we have to record the proper amount. So to correct the incorrect amounts, we would debit sales revenue and credit retained earnings for 3,000. Let's go back and see why that is to make more sense of it. So let's see. So now we're talking about, we're in 2027, right? And we have recorded this entry. This is the only entry that's on our books, okay? This entry is not on our books at all. And so the accounts receivable portion is correct, okay? So we're not going to change that because we do have an accounts receivable for $3,000, and that's proper. It should have been recorded last year. It's recorded this year, but it's correct. This part is we should not be recognizing revenue in 2027 for 3,000, which is where we get the debit to sales revenue for $3,000. Okay. And then the credit goes, because when you look at last year, what should have been recorded last year? Well, this whole entry should have been recorded last year, right? Well, we've already recorded the $3,000, so we don't need to account for that anymore. This credit to sales revenue should have occurred last year, but obviously we can't record in the current year because the income statement closes to the retained earnings. This sales revenue would have increased retained earnings last year, which would have increased our beginning retained earnings this year, meaning in 2027. So we have to credit retained earnings. We have to increase our retained earnings for $3,000. So that's why I wanted to go through it and show you guys, because I think just seeing like this might be a little confusing as to why we're doing this, but that's why. This debit is removing the 2027 sales revenue number that should not have been recorded in 2027. And instead of, since we can't record the sales revenue in 2026, we have to record it, book it in the retained earnings account. Now, in 2027, when this error was corrected, it was discovered and corrected, then when we do the financial statements and we show the 2026 financial statements, next to the 2027, those 2026 financial statements are incorrect, right? And they have to be retroactively restated to reflect the correct amount of sales revenue and accounts receivable when those statements are reported again for the 2027 10K. So let's go into step 3 and see how we report this on the financial statements. And because the 2026 retained earnings, right, the ending retained earnings was incorrect, there's really one of two ways this can be presented on the financial statements. The first one is you take the, well, now my 2026 net income is going to be presented correctly, which means that my ending 2026 retained earnings will also be correct. And either that corrected retained earnings can go right into the 2027 beginning retained earnings, and you don't show a prior period adjustment, right? Because it's already fixed through the 2026 net income. Or you restate the 2026 as discussed, journal entry, retained earnings. When you're looking at the 2027 beginning retained earnings number, it could also just show the old 2026 ending retained earnings number before the correction, and then show a prior period adjustment for $3,000, and then you have an corrected beginning retained earnings number. Both presentations are acceptable. The simpler, this one is more what you see in practice, but this one is probably what you would see on the CPA exam, just because they really want you to understand this point of what a prior period adjustment is for. And then step 4, no matter how you present on the financial statements, a disclosure note is required, and it should describe the nature of the error, the impact of the correction on each financial statement line, which in our situation would be that our net income was understated by $3,000 in 2026, and any earnings per share amounts that were affected for the prior periods that are presented. Let's do a concept check. Global Products overstated its inventory by $30 million at the end of 2026. The discovery of this error during 2027 before adjusting closing entries would require what? So in this situation, we know it's not self-correcting because Usually, if we have an overstatement or understatement of inventory in 1 year, it is self-correcting the next year. So the 2 years combined cumulatively will have the correct cost of goods number and the correct ending inventory, but just the cost of goods sold number would be incorrect in each individual year. But in this situation, we've discovered it in 2027. So if ending inventory is overstated, it's too high, that means the reverse is true for cost of goods sold. That means the cost of goods sold was understated in 2026, so which means it was too little. So we need to increase our cost. We should have had a higher cost of goods sold in 2026. And the way we would have done that is through debiting cost of goods sold. But we didn't do that in 2026. So now we come in 2027. And because we cannot debit or credit income statement account from last year, we have to use retained earnings. So instead, we would debit retained earnings, right, for $30 million, and we would credit our inventory for $30 million. And we have to do that because our books have not yet closed. So this says the closing entry would require a debit to inventory of 30 million. That's not it. A prospective adjustment in 2027 income statement. So this means we just fix the adjustment in the 2027 income statement. No, we don't do that. We would have an increase in retained earnings. No, a debit to retained earnings is a decrease, which means that it's none of the above. Okay? So that's how you do that problem.